Hello everybody and welcome to the Cyclical Investors Club YouTube channel. As always, this is not investment advice. This is just for educational purposes only. Today we're going to talk about two reasons why I've avoided State Street stocks since 2019. I decided to write this article because the stock recently sold off quite a bit, 10 or 15% in a day or something like that. And I figured quite a few people might think that it looks pretty cheap. I saw a couple bullish articles, and then I looked back, and I had actually bought this stock back in 2018, probably for similar reasons that a lot of people might consider buying it now. But I realized by 2019 that there were some issues that caused me to sell the stock, and I had never written like a public follow-up. I think I might have just noted it in a blog at some point along the way as kind of a footnote, but I didn't write a full article on it. So I thought I'd write one and just explain why I've stayed away from it for the past couple years. 4 years, I guess. So when we first look at State Street, when I first bought it in 2018, I treated it as a deep cyclical stock. And that's because back then I used to base all my cyclical strategy on price cyclicality. So this is a drawdown chart going all the way back to the 70s for State Street based on the stock price. So this is how far it's fallen off its highs during these times. And when I bought it in 2018, I want to say we were maybe around here somewhere. So we were well off the highs. It looked pretty decent if you compared it to like previous down cycles, with the exception of the Great Financial Crisis. And it did actually eventually recover from that. So it has always recovered from these down cycles. One thing I would note just now that I'm looking at it again is since about 1990, the time it takes for it to recover has gotten longer each time. And that's usually not a good sign. So a little bit longer in the 90s to recover. This is probably... I know we raised rates here. I'm not quite sure why maybe there was a savings and loan thing around that time. I can't remember for sure. But, and then after 2000, it took a little bit longer for the stock price to recover its peak. And then after the Great Financial Crisis, it took a little bit longer. So one would have actually expected that this should have probably recovered before the COVID pandemic. So, and it didn't. It started to, and then it just kind of faded. And so it's actually never recovered those 2018 highs yet. And this looks more like a pattern of ever expanding kind of recovery periods. I didn't really pay too much attention to that, I think, when I first wrote about it. It might have had something to do with why I sold a little bit, because we do see a pattern kind of established here, and I'd note that with some stocks. But the real reason is that starting in 2019, I added another strategy, and it allowed me to kind of create basically another category of stocks that are kind of in between a deep cyclical and kind of a less cyclical. Usually their earnings are kind of moderately cyclical, while the price is deeply cyclical. So the cutoff line I roughly use is a 50% drawdown for these. So earnings during the Great Financial Crisis only fell about 40%. Now that is like significant, but it's not more than 50%. So I would consider these earnings kind of moderately cyclical, but the price fell 83% off its high. And so that would definitely be deep cyclical. So we have a space here where there's a little bit of a mismatch between the earnings cyclicality and the price cyclicality. And this is where it can create some good opportunities if you pick the right stocks, because they basically will give you a really deep price, and then if they survive and recover, you can do really well. And so I had several banks during the COVID crash that I was able to do that with that kind of fit the same category. But I thought State Street was a little weak at that point. And I'll get into a couple of the reasons why here. So I actually didn't buy it during the COVID downturn. So one of the things I like to look at is a 3-year revenue. Well, if you look at just the general revenue trend over the past, I think this is a 10-year chart, we can see that right about the time the stock peaked, revenues started a downtrend, and then the stimulus money probably helped boost it up so that we're more looking at like flat revenue growth. A lot of times companies can kind of mask a little bit of their earnings problems, but it's a lot harder for them to mask the revenue problems unless they're buying up other companies. So we sort of see this trend here. That was concerning. This is one of the reasons why I stayed out of the stock, because even before the COVID thing, revenues were already struggling. And if probably without stimulus, this trend probably would have continued. Okay, so and then if we go back to 2010, revenues are only up 15% over this entire 13-year time period or so. I mean, basically it's about a 1% CAGR. So they're growing revenues from this time period only about 1% a year. Now, if you started it down here in this little valley, it would be a little bit more. But again, with the recent trend is also about 1% a year. The last 3 years is about 1% a year. So I think it's fair to say revenue growth is only growing 1% a year. That's less than inflation. So that would be a reason for me not to buy the stock pretty much all by alone by itself. But then we also have slow earnings growth. Now, sometimes a company can have kind of weak revenue growth or flattish revenue growth, but if they're divesting businesses that aren't like making much money, then sometimes that can be okay if earnings growth is still good, right? So if the bottom line is still good because they're kind of getting rid of maybe low margin businesses or businesses that are shrinking, things like that, then so it's good to look at both revenue and the earnings growth and together as to kind of get the full picture or a fuller picture. So the green area here is the earnings growth. And one thing a lot of people forget to do is, so that's based on earnings per share. Because it's based on earnings per share, I adjust for the buybacks that they've made because that will prop up that earnings growth. So once I control for that, I get earnings growth, annual earnings growth at about 3.48%. That's basically what inflation has been over this time period if you average it out. So we'll call it flat earnings growth, flat real earnings growth, or slow nominal growth. So it's not bad yet. And if they were maintaining this kind of thing for a long time, and they were also returning that money to the money that they were making to shareholders in the form of a dividend. Now they do have a dividend, but the yield is only 3%. I like for a slow / no growth business to get a dividend yield of 8% before I would consider it a decent deal. Because sometimes if you get one of these and you buy it and you have a big enough dividend yield, you can earn your money back by the dividend yield. And then if they have a couple years where they have a couple good years and improve things along the way, then you can get sometimes a really big bump in the stock price. And so you can kind of, maybe you get lucky and you can get a nice winner out of it. And then if things go as planned, you just get the 8%. Plus the stock price maybe rises in line with inflation, in line with that earnings growth. So you're getting close to 12%, right? That would be kind of the base case. But usually, I mean, if a stock has earnings that are barely growing, they can go negative, and every company kind of has a life cycle. So the risk is that the earnings decline over the years, and you slowly kind of lose your money. And that's why the dividend is important, because it's sort of an insurance policy. If you hold this stock for 7 years, you're going to earn like 3/4 of your money back, or 2/3 of your money back maybe by just the dividend. And so it's a little bit of an insurance policy if the company does kind of stagger. I've found that the market is usually pretty good at kind of pricing these no growth businesses, and so usually the dividend is what you're going to get once you get to a no growth business, unless something bad happens and then you lose. So the risk reward is not usually great with these sorts of companies, especially right now when people are looking for dividend yield. So I don't really own any of them anymore. I owned Philip Morris for a while. I basically earned what the dividend was paying for like 4 or 5 years, so, and nothing more, and I sold it this year. So, and that's probably what I would expect, but with a 3.5%, that's just not enough. I mean, it should probably be 50% less. The stock price should, before it would be attractive to me. So I just wanted to point that out, and a couple things to think about. Look at those share buybacks. I'll have a video coming out on that soon too. You want earnings growth to be at least inflation and preferably above that. The closer the earnings growth is to inflation, the more you want in a dividend to make up for it. Yeah, some stocks aren't necessarily dangerous because the price is going to fall 70% in a year. Some of them are dangerous because over time you just lose a little bit either to inflation or just overall, or you just get flat returns for a long period of time. And I think from the time I had originally bought this until now, I went and looked, the returns are basically flat, but the S&P 500 is up 50%. So, and that was over maybe, a 5-year period. So think about that. You hold something for 5 years, the market does 10% a year, but you're flat. Inflation has probably been 3% a year, so during those 5 years on average. So you lost 30% in purchasing power. So you kind of slowly lose your money. And I think if you have a lot of these stocks, over time, it can really hurt your returns. So just some stuff to think about, and hopefully that helps you. If you like this, subscribe to the channel. The Cyclical Investors Club Premium, I'll have a link in the description. It's $30 a month over at Seeking Alpha. And you can also go over there, read this article. I have a lot of free articles. And just let me know what you think. Later.